Hey everybody, Greg Barron here, Professor of Real Estate. Thanks for joining me today. And you're going to want to stay tuned because I'm going to show you how you can use very little of your own money to do a commercial real estate deal. Stay tuned. We're going to talk today about how I transitioned over the course of 40 years of being in the business from doing single family investment to commercial deals. I'm going to tell you a real deal that I've done, that I've financially modeled, that we've put together, and it started off with very little of my own money. Now, a lot of you are wondering, just how I get into the business and how can I do it with the money that I have. Well, there's a concept called sponsor and investor that the big boys use and the smaller one use, and if you learn how to master this, if you learn how to understand what a sponsor and investor is, how some terminology works, and how to financially model it, I think that you too can be successful, and you're going to want to be able to do this in the coming months and the next couple of years because there's some deals coming down the pike. First, though, let me give you an offer. I am just now completing the final draft of my latest book, The Complete Guide to Commercial Real Estate Investment. In this book, I've basically got 36 chapters of information of 40 years of journey. Some of the chapters include, and I'll read these off to you here, are how to find commercial real estate properties, really basic elementary stuff. And it just moves through the stair-stepping of what I've learned and how to accomplish them. Another one is how to determine quality purchases, specializing in one asset class and the value of focus. Another one is the dangers and safeguards of real estate partnerships. I talked to you about putting together a limited partnership, how to house it in an LLC, and the strength of those if you start to build on those properties. Another one is the understanding the different types of commercial leases. And then I go into, ultimately, I talk about financial modeling. I go into descriptive form about the terms that you need to use. Debt service coverage ratio, debt yield, NOI, all of those things that you're going to need to know. I line it out like Ned in the First Reader. Spent a lot of time on this. It's taken me close to a year to write. I'm coming out with it pretty soon in about 6 weeks. I have determined that I'm going to give away the first 25 books to those of you who contact me here on this channel. Don't have to worry about postage or anything else. I'm going to go ahead and get it in your hands, and I'll even sign it for you, and we'll stay in touch from there. But today I want to go into how I put together a deal with very little money and how you can use some of these same concepts. I'm going to use a software that we've developed. In all transparency, over the last 3 years, we've had 10 programmers working 40 hours a week each, writing code, basically taking some very complicated Excel worksheets that were sometimes fraught with circular errors. And so we decided many years ago that we were going to develop a very simple, effective, quick software. We like to say it's as easy as color by numbers, but as sophisticated as a masterpiece. So I'm going to use this to show you, and forgive the detail right now, but there's something that you need to learn. It's called waterfall investing. Now, waterfall investing basically is an opportunity for the sponsor, i.e., the owner who starts to originate the deal, to be able to develop this process where you can present things to owners by protecting the first preferential returns in different levels. That means that you're going to give them the first 90%, and I'm going to show you this in this scenario, the first 90% of the return up to 9%. Anywhere between 7 and 9% is where typical investors want to have this preferential, and a lot of times the cash-on-cash return first. And then we'll establish another hurdle, meaning between 9% to 14%. Ultimately, it will reduce the amount as your work increases and the return increases. And I'm going to help you understand, hopefully through this process, how the big boys do this and how you can apply the same things if you're just entering into this space, or if you want to further refine how to raise capital investors and do it in a way that shows integrity and do it in a way that shows that you have their interests at heart first, but you want to participate on the back end at a greater and greater level. So before we do that, let me set the table for what kind of project this is. This was a smaller 11,000 square foot property. It needed rehabbing. It didn't need to be gutted, but it did need some value add. It had a couple of existing tenants, and it needed to be refreshed. It was in a great demographic and geographic area. It was a medical office building that had lost a few tenants, but it was right next to a hospital in a vibrant part of a southern city. And I won't give away all of it because I want to protect some of the names of the innocent. So let's pop into Performa Plus, but first I want to add that I've already populated most of the information that I need. I know my development cost, I know my acquisition cost, which I'll go over, but where I want to center on is now that I have this information loaded, how can I best determine a value proposition for my investors that will excite them to get into the deal? How can I compensate them for the equity that they've contributed, but also compensate me or you as the developer for the hard ground that you'll plow? So today, the only thing that I want to do is draw your attention over to the far right-hand column of this spreadsheet called Common Equity. Now you'll notice that I have 3 different hurdles that I've installed here. In this particular system, you can have as many hurdles as you want, but I like to only add about 3 hurdles to make it simple and not complicated. The way that I established those, and when I originally set this up, I told my system, I want to have 3 hurdles maximum, and then I want the first 9% to go 90% to the investors and 10% to me, the sponsor. The second hurdle, between 9 and 14%, I want to give 70% to the investors and 30% to the sponsor or myself. After I've achieved 14% return in distributions, then we would split everything 50-50. So hopefully you'll understand that this incentivizes the sponsor to work hard to get to these hurdles, because you want your investors to have a great return. You want your investors to also have the bulk of the first part of those returns to enable them to have the appreciable value that they deserve. But it also says, once we achieve these, we want our returns as the sponsor to get greater and greater. So as I set up this project, I'm going to go to my capital stack here and show you how this common equity is derived. So here I've got the sponsor or myself or you as a developer having 15% of the equity that's required. And you'll notice under this situation, that's $225,000. Now, I could change this to 10%. That just means that I have to increase the part that I raise. And it's also important to note that the less equity you have, the higher your return rate ultimately, because you're leveraging money. It's the same concept as leveraging equity and debt that you have at the bank. The higher you lever, the more that your return should be, because you're working off somebody else's money. The challenge if you do that with the bank is the higher you lever, the lower your NOI, because your bank note is going to be higher. The concept stays the same in a sponsor-investor relationship with common equity, limited partners to general partners. I'll point out also that most deals that you do, you don't want to be less than 10%. Now, ours is much greater than that in many cases, but if you're starting out and you only have 10% of the equity, you give away more return on the front end. Let's go back to the common equity worksheet, and you'll see that the sponsor here is only contributing 15% of the equity, and the remainder, or 1.2 million, is being contributed by the investors, and it's in varying degrees of percentages. Now let's go back to the project center, and again, let's look at the hurdles. Let me remind you that we're given a 9% pref return, and we're going to give 90% to the investor and 10% to the sponsor. Once it hits 14% or 14% and below to 9%, 70% to the investor and 30% to the sponsor, and then you split it 50-50. Now let's look at the upper right-hand column, and based upon that, look at the return that the sponsor gets, or the developer. It's 47%, and the internal rate of return for the investor is 23%. So why is that? The reason is what I just said. The lower your equity investment, the higher your return could be. The challenge with that also is that a lot of your investors want you to have as much skin in the game as possible as well. So there's a psychological barrier there that you probably don't need to be less than 10%. But I'll show you that your returns are always going to be more, all things being equal. Let's go back into this financial modeling, and you'll see that the equity multiple is 6.3x of the original contribution for the sponsor and 2.46 for the investors. Now you remember in the scenario that we as sponsors put up about $250,000, and the ultimate distribution at the end of the day is around 1.4 million. The investors put up right at 1.2 million, and their return is 3.1 million. As we look at this, it's not a bad deal. Now let's say we want to play with this waterfall scenario, and we're getting a little pushback from our investors, and they would prefer to have a higher threshold on hurdle 2. In this scenario, it's real easy. Maybe they come back and say, no, I want that second hurdle to be at least 17%. So in this case, I would change this to 17%, and I want you to watch how this internal rate of return and equity multiples increase for the investors. And as we push save and recalculate, you can see that now the equity multiple goes up to 2.5, and the internal rate ticks up to 23.5 there. So every change that you make here reflects an ultimate change in the distribution here. So in this particular video, I don't want to get into the minutia of going out cap rates and all those things. We're going to look at those things with some subsequent videos to come. The main thing I want to drive home on this is the concept of the waterfall tiered pref rate scenario, so that you as an investor with a small amount of capital can control a much larger piece of the pie if you've got this ability to financially model and present it. I hope that helps. We're going to have some subsequent videos on how to model this a little bit more, because I really want you guys to be able to enter this market, use a small amount of funds, gain some capital from investors, and develop your wealth. As always, hit the like and subscribe if you want to continue to hear some of these concepts. Reach out to me with any questions, or remember, always educate and then evaluate like we're doing today, so that you can ultimately execute to increase your own personal wealth. We'll see you soon.